Hey, business owners, we know you know the importance of maximizing every dollar. With the Delta SkyMiles Reserve Business American Express card, you can make your expenses work just as hard as you. From afternoon coffee runs to stocking office supplies and even team dinners, you can earn miles on all your business expenses. Plus, you can earn 125,000 bonus miles for a limited time through October 29th. The Delta SkyMiles Reserve Business Card. If you travel, you know. Minimum spending requirements and terms apply. Offer ends October 29th, 2025.
Reality radio for a really great future. We're talking real money.
Didn't we just do a Saturday show? I mean, like a day ago? Feels like it. My time flies when you get old, doesn't it? Hello, everyone. Don McDonald here with another exciting Friday edition of Talking Real Money, where we answer questions. Well, where I answer questions, there is no we unless it's I could be a royal we, but I think I'll just be a less royal me. I will answer your questions if you send them in. But only if you send them in a very special way will I do them on the Friday podcast. Yes, you must go to talkingrealmoney.com. Then there's a button that says, Contact Us. Hit that button. And then on that form, there's a microphone. Hit that. Record your question with the really excellent mic on your phonic device, your phone device, or on your computer, particularly if you have a good mic like I do. This is a good mic hooked to my computer. And you record your question, then it magically flies across the internet to me, and I answer it here on this podcast. There's another way to talk with us and talk to us one-on-one, and that's to call us on Saturdays, though. 855-935-TALK. Just call that number every Saturday, 3 to 5 p.m. Eastern Time, and we'll talk that way, too. Or go to talkingrealmoney.com and send your question in. You can also type it, okay, but I prefer if you speak it. Like our very first questioner did. Here, right there. There it is.
Hey, Don and Tom, this is Scott from Louisiana. Really appreciate the podcast and the entertainment and great information that y'all provide. I got a couple of questions for you. A few months ago, I was laid off from an employer. In that account, retirement account, I have just over $1 million, and 75% of that is in a Vanguard Institutional 500 fund. Symbol is VFFSX. The other 25% is in a Vanguard Target Retirement Date of 2045. I believe that's also a large blend fund. Is the silver lining in this being laid off is that I get to roll this retirement over into my own personal IRA and diversify a little bit more to a little more large, mid-cap, small value, more international. So is that maybe a silver lining and all that?
Look at you, the optimist. Now, you had another question, so I split that out, and I'm going to hold that one because I want to answer the two separately because they're very different questions. Yeah, I guess you could look at that as a silver lining. Getting laid off stinks, particularly when you've apparently been with a job for as long as you have, long enough to accumulate $1 million in your defined contribution plan. Holy mackerel. You've either put a lot away. Well, you still had to have been there a long time to put that much away. So yeah, that is definitely a bright side because it allows you to build a better, a more well-rounded portfolio by emphasizing small cap value, getting the international exposure you really want to have in your portfolio, getting the right percentage of bonds or fixed income for your risk profile. So yeah, that's a silver lining. I'm really sorry you got laid off. It's weird. A lot of people are getting laid off right now. A lot. My daughter was just recently laid off, and it does stink. It really does. And I hope it doesn't indicate some bigger problems economically, but it could. Who knows? Thanks for that question. Now let me get to your next question.
The other question is, what are your thoughts on, I don't know if I've heard y'all answer or talk about this, but what are y'all's thoughts on using funds in your IRA to invest in real estate? I don't know if I've ever heard y'all answer that, but love to get y'all's take on that. Thanks.
Yeah, well, we've answered it, and the answer has been consistently don't. Because I know what you're talking about. You're talking about investing in individual properties using your IRA. You need a specialized self-directed IRA first to do that, and they tend to be incredibly expensive. And real estate, if you're managing individual properties or buying properties to flip, it's a business. It's not an investment anymore. So that should be separate money. You don't play with your retirement. And that's really, when you're going into an individual business, it's a gamble. It's big. I would not be gambling to that extent with my IRA. Now, to tie it into your previous question, I mean, between the two accounts, you should own some real estate in a REIT fund like Vanguard's Real Estate Investment Fund. But no, do not use your IRA money. Do not use your IRA money to buy individual pieces of real estate. High risk, high cost. We do not suggest it. Thanks for your call. Here's our next call.
Tom and Don, I see today Vanguard has announced active ETFs. So do you think they will offer versions of Star, Wellington, and Windsor funds? I'd ask your opinion, but I'm sure it will be that factor beats index, index beats active. Thanks.
Are we that predictable? Yes, we are that predictable. We're very predictable. But the reason we're predictable is because we're consistent, relatively consistent. We do change our minds from time to time, but facts is facts, and we believe in facts. So if you can use facts to show us we're wrong, we'll change our mind if the data set is large enough. So, yeah, factor beats index beats active. Therefore, why would you want the Vanguard active ETFs? I don't know. I can't think of a good reason. Here's how it shakes out right now. They've only announced 3 funds. The first one is the Vanguard Wellington U.S. Value Active Fund, which is a clone of Windsor. It's a lot like Windsor. So it's Windsor. The Vanguard, see, Wellington is the management company, so don't let the Wellington name confuse you. Wellington is literally the management company that Vanguard has had under their umbrella for decades. The next one is the Wellington U.S. Growth Active ETF, which is a global, growth-oriented, large company equity fund. And then the final one for now is Vanguard Wellington Dividend Growth Active, which is basically the same as their dividend growth fund. So that's how it shakes out right now. Can I think of a single reason to own them as opposed to their index products? No, I can't. Thanks for your call, though. 855-935-TALK is that old-fashioned phone number that you can use to have a conversation with us only on Saturdays. Just on Saturdays when we do a live show in Seattle. You call us 855-935-TALK, and we will talk to you between 3 and 5 Eastern, noon to 2 Pacific on our show. And then it becomes a podcast. Or you can go to talkingrealmoney.com, click on the contact form, and type a question or speak it like the Friday people do.
This is Sylvia from Connecticut. I have 2 mutual funds here for a retirement target fund of 2035. I have symbol V, like in Victor, TTHX, which is a Vanguard 2035, or the Schwab 2035 as SWYFX. I'd like your opinion on both of them, which one you think is better. Somewhat comparable. I have a Schwab account, and the VTTHX has a fee to go along with it. So I just don't know what the fee is. I couldn't find it. And I just want to compare, if you can compare both and give me your opinion on those, I would appreciate it. That's all. Thank you so much for all your help.
You're welcome. And they're pretty similar funds. They both have the exact same expense ratio of 0.08% per year, practically zero for all intents and purposes. The portfolios is where there is a bit of a difference. They're similar, But the thing I like about the Vanguard fund is that it has a substantially higher allocation to international markets. So that's a big plus for me. If all other things being equal, I would choose the Vanguard 2035 over the Schwab 2035 for that reason alone, because I think the higher allocation to international just makes sense and basically follows the science. However, there is the one nasty little fly in this ointment, and that's the transaction fee that Schwab charges. They don't charge it for their ETFs, but they do for mutual funds that don't pay them something, like Vanguard, or that aren't their own funds. And that fee is $75 per transaction. Now, if you make one big transaction all at the same time, that $75 hardly matters. If you're going to be buying into it slowly over time, that $75 can be onerous. Now, it won't exceed 8.5%, but that's pretty expensive. So they're saying for smaller contributions, it wouldn't go all the way up to 75. But that might tip the scales in Schwab's favor slightly because they are similar enough. But I'd rather have the Vanguard, again, all things being equal. Thank you for your question. And because we didn't get as many questions in August as we usually do, we have to end this one at just 4 questions, so I have enough for next week. So, we're at the end. Here's the last one.
Hi guys, I have a question about asset allocation. I am 26 years old and I'm a U.S. citizen currently living in the country of Colombia. I bought an apartment here for cash last year for $109,000, which has significantly brought down my monthly housing costs to under $200 a month. I have a net worth of about $225,000, which means that about half my money is invested in this apartment. What's prompted my question is the recent decline in the US dollar of about 10%, which means that the value of my apartment has conversely increased by about 10% in US dollar terms. When I realized this, I began to wonder if I should change the allocation of international stocks in my stock portfolio to less than the current 30% due to my international exposure with real estate in Colombia. Should my apartment have any weight in how I allocate my investing portfolio? Or does it being in a different asset class than stocks have nothing to do with what I should be doing with my stock portfolio? Thanks so much.
Well, the closest category is that it doesn't have anything to do with your stock portfolio, but the reality is the broader issue is it doesn't have anything to do with your portfolio. You should never, ever factor your house into your investment portfolio. A house is not designed to be an investment. If it turns out that way, cool. But that shouldn't be the primary purpose of owning a house. They generally don't appreciate a lot. Generally. Nationwide, globally. However, for determining what your net worth is, yeah, they should be considered because they're an asset of value. But I don't believe, and I know Tom does not believe, that you should include that as part of your portfolio. And by the way, it's not really a foreign stock asset because it can't grow on its own. And the only kicker you're getting is because of the currency exchange rate. And that's nebulous at best. So, no, do not include it in your portfolio. Your portfolio for asset allocation purposes is the other 110,000 or 115,000 or so you have elsewhere. That is what should be allocated according to your risk profile and your needs and wants for the future. So thank you so much for the questions. All of you, thank you for the questions. We really do appreciate getting them. And here's hoping we get a ton more so we can make the Friday show even longer. I love it when I can get 5 or 6 in, but there just weren't enough of them. I need some for next week. So take good care of yourselves. Please tell a friend or two or 1,000 about the show. Do you have 1,000 friends? If you do, good for you. Please go to talkingrealmoney.com and send in your questions. Also, if you want to meet with one of our Appella advisors for free, for nothing, with no obligation and no high-pressure sales pitch, really, we'll spend a little time with you. Like, if you wanted to ask us, should my house be part of my portfolio? Can you look at my portfolio? We'll do that for you for nothing. You just go to talkingrealmoney.com, click the button that says Meet an Advisor. Heck, you can even meet with Tom if you can take the bad dad jokes. I'm Don McDonald. Thanks for listening. We're talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.